Everyone, Joe Gentili from Left Tail Risk Advisors. In this video, I want to make a video about life insurance as an asset class, how to think about it, how to think about permanent life insurance as a place in your total asset portfolio. And I'm really going to be focusing on whole life insurance. So, as I've said in other videos, there's other types of life insurance, variable, universal, but this is really about whole life insurance. And I think some people frame whole life insurance or permanent life insurance, really they think of it as an expense. That it's a premium that you pay every year and it's an outlay of money. It's not really an expense. It's really taking money from holding it one way to holding it in another way. It goes from holding cash outside of a life insurance contract to holding it inside a life insurance contract. So life insurance has a different property than other types of assets like stocks and bonds that make it attractive. So number one, there's the contingent nature of life insurance that you're paying into the asset small amounts of money, and if an event occurs, like primarily death, or if there's a need for long-term care and you have a long-term care rider, that small amount of money turns into a much larger pool of money at the exact point in time that you need it. So there's a contingent benefit to the asset. There's also the fact that it's a very low risk asset. If you own life insurance, whole life insurance with one of the large mutual insurers, it is one of the safest assets that you could possibly own. So if you think of yourself as having an amount of risk that you could afford to take in your financial life, you have a pie chart or points of risk. You want to allocate some risk to owning a business and running that. You want to allocate some risk to investing in real estate or investing in stocks. Life insurance is not going to take up very much of that risk pie. So it allows you to allocate the risk more efficiently to other areas. So by having this asset like life insurance that's guaranteed by a blue chip company never to go down in value, it allows you to allocate that into other areas and take more risk into other areas without being reckless. So it's an asset that could improve returns of other assets in that way. There's also the tax advantages that come with life insurance that are pretty unique. It may be the single most tax advantaged asset in the federal tax code, where you're able to put money into the policy, it grows tax free, and it pays out a death benefit income tax free. If you own the asset in a trust outside of your estate, it could pay out estate tax free. You could take loans out tax free. So lots of tax benefits. And unlike other tax advantage assets like retirement plans, there's not any income restrictions to it. There's no real restrictions on the amount of money that you can put into it. So it's a very flexible, um, it's a very flexible asset to own with a lot of tax advantages. And those tax advantages just accentuate with the higher your income is. So also, if you look at the returns of it, the returns on life insurance, particularly a whole life insurance policy, you're giving your money and you're allocating it to the general account of an insurance company. That insurance company, if it's a mutual company, you're going to benefit from the operating profits of the company. Mostly, you're going to benefit from the investments that the life insurer has, which is mostly invested into um, high quality, low risk fixed income type assets like treasuries and other types of safe bonds. And you get to benefit from the fact that these life insurance companies have very sophisticated teams of people investing that money. And so they're investing your money along with it. And over time, if you hold the life insurance contract for life the way it's intended, you should expect to get on your cash value and on your death benefit bond-like returns or safe bond-like returns with the added advantage of having these tax benefits that you wouldn't have if you owned it in a taxable account. So the policy is, in terms of returns, it operates more like a very good savings account or a high yield savings account rather than comparing it to the stock market. It's not a it's not an apples to apples comparison to compare the growth of cash value in a life insurance policy with what you would do with the money if it was invested in the S&P 500. The reason for that is because the risk profile is just completely different. One is invested in safe bonds. You have an insurance company guaranteeing that the value can never go down as long as you pay your premium. The other is you're in the markets. So it's very different in that regard. There's some downsides to having life insurance as an asset, like any other asset. And I think the primary downside has to do with this is a lifelong commitment. You're buying a life insurance policy, and all of these benefits that I'm describing really only come to fruition if you hold the policy for life and the policy eventually pays out that income tax free and if held properly, estate tax free death benefit. So it's not like a bond in the sense that you could buy it on year one and sell it in year five. Life insurance doesn't work that way. Life insurance takes a long time for the benefits of it to really become apparent, assuming you don't die early in the contract. So for the first, there's a lot of different ways to structure a life insurance policy. You could structure where it accumulates like high cash value early, or you could structure it where the cash value is relatively underemphasized, but you're growing the death benefit faster. But generally, for the first few years, maybe even the first decade of owning a life insurance policy, if you're just looking at the cash value, it is not going to look like a very attractive investment. That changes over the decades. It does look a lot better later on because there's a lot of early expenses that have to get paid and dealt with a life insurance contract. So it's really not a permanent life insurance policy is not something you're going to want to own looking for a great short-term benefit out of it, but it is something that ages well and something that can be great to own as an asset if you hold it and use it for its intended purpose, which is lifetime ownership, to eventually get converted to a death benefit to pay out your heirs. So, any questions on this and on the where life insurance can fit in the asset portfolio of life? Feel free to reach out. And if you found this video useful, I certainly encourage you to subscribe for future ones. Thanks.